Advice on how to better manage your portfolio. Let's talk to Puru Saxena, money manager and CEO of Puru Saxena Wealth Management, and he joins us live from our Hong Kong studios. Thank you so much for dropping in, Puru. Let's want to drill down some of the data points that we got out from China. Yes, GDP quite strong, relatively tame inflation. But what I thought was interesting was that whatever pressures that came in terms of inflation actually came from food costs. And all along this year, you've been talking about how that could really stoke inflationary pressures here in Asia. Does this mean that investors should get into the soft commodities, and that would certainly be a better buy at this time?
Well, we don't have any positions in agriculture because it is a very difficult sector to participate into from an investment perspective. Chloe, the agricultural sector is going up. There is no question about that because of supply and demand. The problem is for the retail investor, it is very, very hard to play this because unless you're an experienced futures trader, when you can go long or short in different specific agricultural commodities, to buy a long-only agricultural ETF, which just simply tracks the agricultural basket, doesn't really do well if the commodities are in contango where the future prices are higher than the current ones. So unless you want to buy some fertilizer companies and so forth, I think it is a very highly cyclical sector and quite a difficult one to invest in.
Puru, it's Anna here in London. Some people today are talking about a sweet spot for equities because we seem to have this benign inflation environment. At the same time, corporate earnings are coming through pretty strong. How would you play that into the need to protect people's wealth right now?
Well, the key worry for us, looking out 3 or 4 years, is very high inflation because central banks over the last 2 years or so have printed gigantic amounts of money. They've debased the currencies. They've transferred the debt from the private balance sheet to the public sector. If you look at the debt levels in the Western world, the debt to GDP ratios are off the charts, not only in the West but also in Japan, in most of the developed countries. And there is going to be a payback for all this fiscal irresponsibility, and the payback will be a currency debasement or a currency crisis at some point in the next 3 or 4 years. So the big concern for us, or the big theme, is to protect the purchasing power of the savings from the consequence of this inflation which we've seen over the last 2 years or so. I have no doubt in my mind that if the economy recovers, prices in the economy are going to go through the roof. In fact, I don't even think it is impossible to imagine that the price levels in the United States are going to at least double within the next 6 to 7 years. So inflation protection is an absolute must in this environment.
So, Puru, if you're sitting here in Europe and you've got pounds and you've got euros and you're worried then about that currency effect from this big debt burden that governments have, how are you going to protect yourself from that inflation?
Well, for our clients, Anna, we've invested in the fast-growing emerging economies in Asia. We believe that in this two-tier economy where the emerging countries are doing a lot better than the countries in the West, investors are likely to chase performance or the growth which the companies are going to deliver in emerging Asia, in Latin America and so forth. So we've got positions in China, we've got investments in India, in Vietnam. We also have exposure to resources, companies in energy sector, in the steel sector. We have some precious metals as well, because history has shown that when you have very high inflation or rampant inflation, then commodity prices benefit the most, and companies which are able to deliver growth in a low growth environment are also bidded up by investors.
Right, and Puru, you have a pretty large oil position, and you're thinking there's going to be a big supply crunch in about 2 to 3 years.
Well, absolutely, because if you look at the supply and demand data and ignore the noise, you will realize that the oil companies are really struggling to maintain the current flow rates. And we are fast approaching what we call peak oil, which means that the world's flow rates are about to peak in the next 3 or 4 years. The reserves are going to be around for the next 100 years or so, but what matters is the amount of oil you're able to extract on a daily basis. And the supply of oil seems to be peaking at a time when the demand for oil shows no sign of slowing down, at least in the developing countries. And we suspect that in the next 2 or 3 years, when the economy is on a more solid footing, the price of oil is going to have another massive spike and cause another recession. And this time around, we could leave $147 in the dust.
We'll keep an eye on that space. Thank you so much. Puru Saxena there, money manager and CEO of Puru Saxena Wealth Management.